Investing in times of climate change. The impact of climate change is no longer hypothetical. It's becoming a reality, and it is only going to get more intense over time. The extent of the impact on the global economy, as well as individual portfolios, is still unknown. That said, it's clear that investing in a world that's changing at an unprecedented pace presents a host of opportunities as well as challenges, with an increasing number of institutional investors starting to focus on products and services that can help them mitigate the risks posed by climate change. There are now also more investment firms than ever before looking to tap into its long-term growth potential. In this blog, we'll discuss different ways to invest in times of climate change and how your money will grow with time. Invest in clean energy. The financial impact of climate change is already being felt. In fact, the global cost of extreme weather events has doubled since 1990, with multi-billion-dollar events becoming more commonplace. And yet, investors still don't see climate change as a risk that they should be taking into consideration. Fortunately, new renewable energy developments are not only helping to mitigate the risks posed by climate change but also creating opportunities for investors and those in need of capital. We'll take a closer look at why investing in clean energy is so important for personal and business portfolios. Clean energy investments provide long-term growth and stability. Energy efficiency can lead to reduced operating costs, which can increase profitability over time and make it easier to manage cash flow. Additionally, investments in clean energy also help reduce greenhouse gas emissions and improve public health. Invest in carbon capture and storage. The goal of carbon capture and storage is to reduce the amount of greenhouse gases emitted into the atmosphere. This can be done through various methods, like using carbon capture equipment, capturing methane gas from coal mines, or storing carbon dioxide in underground geological formations. 1. Carbon capture and storage actually has a lot of potential. According to a report by the Carbon Underground, if every country in the world were to implement carbon capture and storage technology on an industrial scale, it would result in $6 trillion in GDP. 2. That said, with little government regulation currently surrounding this technology, it is imperative that investors seek out companies that are committed to building sustainable strategies for mitigating climate change's impact on economic growth. Some examples include investing in companies like Siemens and Global Thermostat, which already have well-developed CCS strategies, or investing in renewable energy companies that are working towards lowering emissions from their operations. Invest in renewable energy. A key way to invest in a changing world is to focus on renewable energy. In addition to traditional modes, renewable energy includes sources such as wind, solar, geothermal, and tidal energy. Renewable energy has the potential of decreasing your carbon footprint, increasing the health of our planet, and creating new industries and jobs. From an investment standpoint, the price of renewable technologies continues to fall, which means that there is still a lot of upside left on the table for this market. When investing in renewable energy, you need to keep in mind that it's a long-term play because they are not yet widely adopted across many sectors of the economy. However, other opportunities include investing in clean transportation or connecting with companies producing products and services that can help mitigate the effects of climate change. Invest in smart infrastructure. The first step to investing for the future is making sure that your investments are sustainable. If you want returns in a changing climate, you need to invest in smart infrastructure. Smart infrastructure can help reduce the impact of climate change. For example, solar power and wind turbines produce less pollution than fossil fuels, while water and waste management systems are well positioned to provide clean energy services over time. Investing in technology that improves local sustainability should be high on your list of potential investments. Stay tuned for disruptive tech. Technology continues to disrupt traditional industries, and with this comes a range of investment opportunities. One way to invest in times of climate change is through the growing number of renewable energy projects and companies that are leveraging new technologies like wind power and solar energy. As these technologies become more widespread and less expensive, these companies will gain significant market share. These investments could pay off over time due to the increasing demand for clean energy sources. Bottom line, investing in times of climate change can help you protect your assets and potentially grow your portfolio. Although the extent of the impact on the global economy is unknown, there are more investment firms than ever before looking to tap into its long-term growth potential. In this blog, we'll discuss different ways to invest in times of climate change and how your money will grow with time. Defining the sustainable investment strategy. There's no doubt that the investment world is going through a period of disruption. The likes of Etfs and robo-advisors have thrown the industry into turmoil, while new technologies like blockchain have radically transformed the way we think about money and investing. It is this uncertainty that has forced traditional investors to take a long, hard look at the way they manage their investments. Fortunately, this has created a wealth of opportunity for those who can identify it. An investment strategy is a process by which an investor anticipates future cash flows and decides how much money to set aside in order to receive those future benefits in the most advantageous manner possible. It shouldn't come as much of a surprise then that creating an effective sustainable investment strategy is one of the most important aspects of any green advisor or financial institution. In this blog, we'll explore what constitutes a sustainable investment strategy, how to develop one, and some effective strategies for incorporating sustainability into your portfolio. What is a sustainable investment strategy? A sustainable investment strategy is a process by which an investor anticipates future cash flows and decides how much money to set aside in order to receive those future benefits in the most advantageous manner possible. Sustainable investments are those that have been carefully crafted with the long-term goals of providing any necessary risk tolerance, while enhancing returns on investment. They are designed to be low-cost, environmentally friendly, and socially responsible. Sustainable investments can be made in a variety of ways, including equities, bonds, property, commodities, or funds. Sustainable strategies can be based on your financial situation as well as your personal values. For example, if you live off an annual income of $25,000 and want to increase your savings for retirement, with a smaller amount of risk than you would take on if you had a higher annual income, then it makes sense to use more conservative investments, such as stocks or bonds. On the other hand, if you earn $500,000 per year and don't feel like you need much for retirement, but still want some sort of return, then it might make sense to invest in a fund that has high risk but also provides returns of 10% per annum due to its high potential for growth. Why is developing a sustainable investment strategy important? If you're a financial advisor or investor, it should go without saying that creating a sustainable investment strategy is one of the most important aspects of your business. That's because, by doing so, you can ensure that your client's account will always be profitable, which means they'll have more money to invest and spend on their lifestyle. Creating a sustainable investment strategy also helps you develop an ethical approach to investing. By prioritizing ethical principles like sustainability, equality, and social justice in your strategy, you not only help the environment and society in general, but you also help yourself financially by increasing your profits. The three main components of a sustainable investment strategy. There are three main components to a sustainable investment strategy. 1. Goals. What are your long-term financial goals? 2. Risk tolerance. What type of risk do you want to take? 3. Investment approach. How will you implement your investment strategy? The first step is to determine what your financial goals are. This can be somewhat difficult, as we may not be able to predict the future with certainty. However, we should at least have some understanding of what makes us happy in our future lives and how much money it would take to get there. Next, we need to decide on our risk tolerance. The more risk a person is comfortable taking, the more aggressive an investor they will be. Finally, we must decide how our investment strategy will unfold and make sure that this fits with our goals and risk tolerance. How to develop your sustainable investment strategy and what you'll need to consider. A sustainable investment strategy is a process of planning your investments to maximize future benefits. A sustainable investment strategy will take into account a number of factors, including how the market is performing, the impacts that future events may have on your investments, and how you want to be positioned in the long term. To develop a sustainable investment strategy, you'll need to consider how much risk you are willing to tolerate, the amount of time you have before retirement, the potential for leverage, whether from debt or from equity, how much money you are willing to invest in each asset class, your tolerance for volatility and uncertainty, what age and stage of life you are at. Strategies for incorporating sustainability into your portfolio. Investors often use a variety of strategies to incorporate sustainability into their portfolio. Some may choose to invest in companies that have an implicit or explicit commitment to impact investing, while others choose to invest in companies that are in the forefront of technological advancements that are environmentally sustainable. In addition, there are several other strategies for incorporating sustainability into your portfolio, including investing in socially and environmentally responsible companies, investing in companies with solid financials, investing in companies with long-term growth potential, investing in mutual funds which have an investment mandate that emphasizes sustainability and risk mitigation. Investing is one of the most important money decisions you'll make. It's also one of the most confusing. The vast majority of Americans are invested in stock market funds, but investing your money isn't a simple binary decision. Investing involves many different factors, ranging from your personal financial situation to climate change and social issues. Understanding those factors is important for anyone looking to invest their money responsibly and prudently. Investing responsibly means putting your money toward investments that will grow over time and provide a higher return than what you pay in fees or taxes. Investing responsibly also means limiting how much risk you take with your money, as too much risk can result in losing everything if you don't do anything else to manage risk. Sustainable investing takes both of these things into consideration. It helps investors make well-informed investment decisions that support a stable, growing economy while minimizing risks associated with them, such as the danger of losing capital if an organization goes out of business. In this article, we explain why sustainable investing is so important and how it affects people who invest their money responsibly. Why is investing important? Investing is important for a number of reasons. First, investing money in the stock market helps people build their net worth and establish personal wealth. It also provides an opportunity to earn a return on your investments and generate additional income. Beyond these purposes, investing is important because it ensures that future generations have an appropriate financial base to live off of. Additionally, investing responsibly helps ensure that we leave the world in a better place than when we entered it. Investing responsibly helps protect our planet from climate change by putting our money toward organizations with sustainable practices and initiatives that help lower carbon emissions. Sustainable investing also helps prevent social issues like pollution by placing capital into companies and organizations committed to environmental sustainability and social justice. This means that sustainable investors can put their capital toward organizations that help prevent environmental degradation and provide funding for people of color, low-income communities, women, or other underrepresented groups instead of just corporations or institutions that prioritize shareholders above all else. Investing responsibly. Sustainable investing is important for people who invest responsibly. Investing responsibly means limiting how much risk you take with your money and investing your money in a way that provides a higher return than what you pay in fees or taxes. It also means putting your investments toward organizations and companies that are not only providing financial stability, but have the potential to grow into something even more lucrative over time. Investors should always look at both the short and long-term effects of their investment decisions. If an investor decides to buy stock in a company, they may be looking at the company's financial performance over next 6 months or year, but they must also consider how sustainable the company is and how it will affect society as a whole over the next 3 decades. Sustaining investing helps the economy. Sustainable investing is essential for a healthy economy. The U.S. economy is largely driven by consumer spending, which makes up about 70% of the U.S. GDP, according to Investopedia's definition. The majority of this money comes from consumers with disposable income, people who have at least $40,000 in annual earnings. People with enough disposable income have the option to spend or save it, and in recent years, Americans seem to be opting more towards saving than spending. One of the reasons this is happening is because a lot of people are concerned about social and environmental issues, including climate change and global warming. These issues contribute to why investing has become more popular among American consumers. They want to make responsible investments that they feel comfortable putting their hard-earned money towards while also helping their communities and contributing to an economically sustainable future. The benefits of sustainable investing. Sustainable investing is important for both investors and for society. Investors are able to make well-informed decisions about whether an investment is worth their time, money, and risk. In doing so, they help grow the economy by supporting a stable environment. Sustainable investors also help to minimize risk. If an organization goes out of business, sustainable investors can still coax out a profit from their investments through long-term asset allocation strategies. Sustainable investing is also crucial because it helps develop the financial industry as a whole. In order to attract the best and brightest minds in finance, organizations need to focus on sustainability. The industry needs people who are looking at where society will go in the future, not just focusing on short-term gains that have already been made by spending enormous amounts of money on advertising. In this article, we've explained why sustainable investing is important, not only for individuals who invest responsibly but also for society as a whole. What are the benefits of sustainable investing? Sustainable investing can offer a few major benefits. For example, sustainable investments can offer a higher return than comparable investments. Sustainable investments also tend to have lower fees than non-sustainable ones, which means that you'll be able to invest your money more easily and grow your wealth faster. Sustainable investors are informed about the long-term effects of their investments, so they know what to expect in the future. They also manage the risk associated with their investments, meaning that sustainable investors are less likely to lose their capital if an organization goes out of business or get burned by market volatility. With sustainability comes responsibility. When you invest responsibly, you take some of the burden off of society and put it on yourself as an investor. This is because businesses that invest responsibly will end up paying fewer taxes and fees on every dollar they earn in exchange for working in environmentally friendly ways, avoiding waste and social issues like human rights violations or factory conditions. These companies usually have higher payouts from investors with successful returns because of this approach to investing. Sustainable investing is important for people who have been tasked with making financial decisions for themselves, or for those who plan on doing so in the future. In fact, 77% say they're interested in learning more about sustainable investing. In 2019, how do you achieve sustainable investing? There are many different ways to achieve sustainable investing. One way is to invest in stocks that represent companies with a strong commitment to social and environmental responsibility. Another way is to invest in companies that are involved in environmentally responsible science, technology, engineering, and math, STEM, fields and fund the education of those students who do not have the financial means to attend college. If you're looking for a more conservative investment strategy, you can diversify your investments across multiple types of stocks and bonds. Organizations like the United Nations Principles for Responsible Investment, UNPRI, offer guidance for investors who want to adopt sustainable investment strategies. They provide advice on how investors can make sure that their investments help protect people and the planet, while still achieving desired returns on their investments. This article explains why it is important for investors to adopt sustainable investing strategies, how they can do so responsibly, and how they should manage risk as they invest responsibly. For many investors, sustainable investing may mean little. However, this is not true for as long as the new norm continues to shift from a traditional mindset of passive and risk-averse investing towards a more active and value-oriented strategy. Sustainable investing is an investment approach that prioritizes companies based on their ability to grow earnings, while also protecting the environment and doing right by their stakeholders, using good management practices and demonstrating positive social or environmental impacts. It's one of many investment strategies that increase a portfolio's or fund's diversification, broadens its risk profile, and provides long-term returns. What is sustainable investing? Sustainable investing is an investment strategy that prioritizes companies based on their ability to grow earnings, while also protecting the environment and doing right by their stakeholders, using good management practices and demonstrating positive social or environmental impacts. It's one of many investment strategies that increase a portfolio's or fund's diversification, broadens its risk profile, and provides long-term returns. It was only 15 years ago that sustainability was largely ignored by investors, but today it has become a widely accepted practice. In fact, according to the 2015 Sustainability Accounting Standards Board (SASB) report, there are now over 7,000 sustainable funds globally. This number is expected to continue climbing as more institutional investors expand their sustainable portfolios. Sustainable investing is not about creating long-term investments for short-term gains. Instead, it's about focusing on opportunities with superior long-term potential returns at lower risk than other investments. For example, sustainable investing may include energy stocks or renewable energy companies, which have the potential to generate above-average returns while also reducing carbon emissions and promoting green industry growth. How sustainable investing works. Sustainable investing can be implemented through individual investments, with a focus on companies that have both sustainable business practices and positive social or environmental impacts. It's one of the most common approaches to implementing a balanced portfolio, and it helps you avoid investing in companies with negative environmental or social impacts. When buying shares of a company, you should really analyze how sustainable that company is before purchasing shares. You want to make sure that the company has good management practices, is transparent about its performance, and has positive social or environmental impacts. For example, if you're looking for an investment in a company that is focused on helping animals by creating animal-friendly products, then sustainable investing may be an excellent approach. If you're looking for an investment in a company focused on mining gold without destroying the environment while also providing jobs, then sustainable investing may not be appropriate as the company may be overmining precious metals, which hurts their long-term sustainability. However, sustainable investing can also be implemented as part of your overall portfolio strategy. In this case, you would invest more broadly and use more traditional passive strategies in between investments in sustainable companies to help maintain your risk profile. Key differences between sustainable investing and traditional investing. One key difference between sustainable investing and traditional investing is the use of metrics. Environmental, social, and governance factors are considered as important as financial ones when making investment decisions. Traditional investors buy shares in companies with a long-term view toward their share prices. Sustainable investors make purchases that are more focused on the company's ability to produce a steady stream of income over time. This view is similar to that of an actively managed mutual fund or hedge fund, which also seeks out companies with a good risk-reward profile while avoiding investments that may not have much growth potential or don't provide sufficient return on investment (ROI). Sustainable investing includes many different strategies and methods, including dividend yield investing, price averaging, beta analysis, fundamental index funds, and individual stocks. The benefits of sustainable investing. Sustainable investing is a great option for investors looking to take on the risk associated with market volatility while potentially increasing their long-term returns. One of the many benefits of sustainable investing is that it can lower a portfolio's risk profile and improve return-to-risk ratios. The U.S. economy has been on a steady upswing since President Trump was elected, raising the question, what would happen if economic downturns returned? The answer is that sustainable investing reduces portfolio risk by diversifying your investments and keeping them in companies with strong earnings performance and/or low financial leverage. This helps you ensure that your investments will survive during tough economic times. Another major benefit of sustainable investing is that it's visible. By putting your money into companies that are focused on doing good for the world, you can show people what you value and increase your social capital. People are often more likely to invest with someone who shares similar values and principles because they view this person as doing right. And, as an added bonus, sustainable investing can be a way to help others. You could gift shares to friends or family members and let them know what stocks or funds you're invested in so they can protect themselves against unethical practices associated with some companies. Why not invest in sustainable companies? There are other investment strategies that can provide a similar return on investment and may have less risk. If you're looking for short-term returns, sustainable investing is not for you. Although it has the potential to generate higher returns in the long term, there is no guarantee. For example, the average sustainable company grows earnings at a 12% CAGR since 2006. However, 77% of sustainable companies had negative value changes in 2017. Sustainable companies also carry more risk than their traditional counterparts and can be difficult for investors to assess, because they don't typically trade on public markets and may spend longer in developmental stages before generating revenue or profits. An overview of sustainable companies and ETFs. The first step to sustainable investing is understanding the different types of companies that are sustainable. A firm can be classified as sustainable if it meets 3 criteria. The company has a positive social or environmental impact. The company protects the environment and does not contribute to climate change through greenhouse gas emissions. The company's earnings grow over time. Companies can also be classified as sustainable if they have good management practices and demonstrate positive social or environmental impacts. For example, Adidas is considered sustainable because it has a positive social impact while adhering to a strict code of conduct to protect its workers. These types of companies are typically found in the Sustainability Index, which is an index that measures the sustainability performance of firms listed on markets like NASDAQ and NYSE. Some examples of ETFs that invest in these types of companies include the PowerShares S and AMP Wink with tongue sticking out 500 Low Carbon Target ETF and the PowerShares Global Water ETF. Sustainable ETFs. As the debate continues over just how sustainable ETFs are, some investors claim that they do not offer sufficient diversification or the returns of traditional mutual funds. However, this is a misconception. A sustainable investing strategy consists of a portfolio or fund of ETFs, which allows for greater diversification and longer-term performance while also offering tax benefits. In addition, it's possible to invest in sustainable companies without having to purchase stock. Instead, investors can invest through mutual funds that own shares in such companies. For many investors, sustainable investing may mean little. However, this is not true for as long as the new norm continues to shift from a traditional mindset of passive and risk-averse investing towards a more active and value-oriented strategy. Sustainable investing is an investment approach that prioritizes companies based on their ability to grow earnings, while also protecting the environment and doing right by their stakeholders, using good management practices and demonstrating positive social or environmental impacts. It's one of many investment strategies that increase a portfolio's or fund's diversification, broadens its risk profile, and provides long-term returns.